we're going to need, this is Learning Objective 5, Module 3. We're going to need to do the same thing now with the income statement. So previously we said that we're going to break the balance sheet down into operating and non-operating components, figure out operating assets, operating liabilities, and net operating assets, which would be another way of saying operating equity. And as I showed you here, we're going to do the same thing with the income statement. We're going to figure out net operating profit before taxes, and just look at the income statement and break it out. We're going to subtract taxes on net operating profit before taxes, which is going to be a little bit tricky. And then we're going to get net operating profit after taxes. NOPAT. So operating profit is really easy. It is everything up to operating income plus income from equity method investments. It's interesting, equity method investments are considered to be operating. And these would be investments, if you took advanced accounting, usually investments that involve 20 to 50% control. And it's a little bit iffy whether they should be included or not. Notice the tax expense is black and red, because tax expense is going to mix operating and non-operating together. Whereas a portion of taxes would be operating and a portion would be non-operating. And in fact, you could have tax expense from operating and a tax benefit from non-operating. It gets pretty complicated. We're going to talk about how to do that. So here, for example, would be Intel. And Intel is quite simply no net operating profit before taxes is $14,002. And then a portion of these taxes need to be split up into operating and non-operating component. So the way you would calculate the tax expense is you would take your tax expense and you would subtract the taxes on the net non-operating items, or you would add it back depending on what direction it goes on. What they call a tax shield. So this would be, it's because it usually goes in the other direction. So usually what would happen is your taxes on your operations would be even higher than your provision for income tax, because there's money that's saved on taxes from non-operating items. So calculating this is a little tricky. Let me show you how you do this with Intel. Intel had net operating profit before taxes of $14,002. The total tax expense from the income statement, if you look back here, was $27.92. They also had non-operating items, shown right here, of $315 and $105. And if you look at them, $315 is positive and $105 is negative. And I just want you to note that here in the example, they said income from equity method is operating. And here they're treating it as gains on equity investments. They're treating it as non-operating. So I think this is really equity investments and not equity method investments, and that's why they're doing that. But I think equity method investment could kind of go either way. But let's just stick with what they're doing here. There's gains on equity investments, or they're not equity method investments, they're investments in equity, and that's an important distinction. Anyway, you can see that the net here is $210, and that's $210 in income. So that creates a tax shield. So 210 times 37% would be 78. So the 78 of this tax expense comes from the non-operating items. Therefore, tax expense excluding the non-operating items, in other words, tax expense on the operating items, is $27.14. And therefore, NOPAT would be $11,288. So again, what you need to do is you need to split your provision for income tax into two components, operating and non-operating. In this case, operating is $27.14 of the $27.92, and non-operating is $78. And we only want to subtract the taxes on the net operating profit before taxes, and then that gives you NOPAT as it's given to you over here. Now let's calculate return on net operating assets in the next video.